Bring in former Deputy Assistant for Economic Policy at the Treasury, Natasha Sarin. She's a professor at Yale Law School and a Yale School of Management professor. And Joel Griffith is a Heritage Foundation economics research fellow. And Natasha, I'll start with you. These probably aren't going to survive as they are right now and become law, but what's your wish list? Is that a pretty good summary of it, what Robert just talked about, or are there some things you like, some things you probably wouldn't try for?
Well, sort of big picture, what I hope we can all agree on is that the United States faces really quite substantial revenue needs. Over the course of the next decade, debt to GDP ratios are going to rise to 119%. Social Security and Medicare trust funds are set to be extinguished. So we need to figure out how to raise revenue. And the president's budget does exactly that. It proposes $3 trillion of deficit reduction over the course of the next decade. And it does so by asking corporations and the very wealthy to pay their fair share in ways that I think make a lot of sense. The top 1% has 40% of their wealth tied up in unrealized capital gains that in all likelihood are never going to face any tax liability because upon death they're just going to be passed down to their heirs and you'll get a step up in basis. I think that's unfair. I think the American people think that's unfair, and I think that is reflected in these proposals.
There's the revenue side and there's the spending side, and whenever we, Simpson Bowls, whenever we try to address it, we try to do both. We spent a lot of money during the pandemic. The budget that was just proposed, Natasha, is almost, it's down a little bit from there, but with the economy we have right now, which is pretty strong, we aren't spending any less. We're increasing spending at the same time. And is that okay with you? That's why we're going to 109. That's one of the reasons we're going to 119% of debt to GDP. If you're going to ask for more revenue, don't you think that on the other side we ought to offset that with some spending cuts?
I think it's important to take seriously, to your point, like this is accounting, like both sides of the ledger here. But I think the point that's really important for your viewers to grasp and that you well understand is like the U.S. is a low tax country. We are like 38th in the OECD with respect to the tax revenue that we bring in. And that's because of over the course of the last decades, regular people are paying the same share of taxes. Labor income is paying an even greater share of taxes than they have historically. What's happened is because of all of these complex corporate structures like partnerships that have all these loopholes, like the one Andrew doesn't like with respect to carried interest, we've seen revenue tail off from high earners and the structures that they own and from large corporations. And I think that's why on the revenue side, we need to think seriously about these raisers, while totally agree that we also need to be serious on the spending side as well. And I'll say that President Biden's proposed $3 trillion of deficit reduction. If you look to former President Trump and what his economic plans amount to, they amount to $5 trillion of deficit increases. So there's a very clear fiscal choice on the table in November.
All right, it's your turn, Joel.
Thanks for having me on. Let's first get a few facts straight here. Let's keep in mind the so-called rich already pay a big disproportionate share of the total income. As you mentioned, the top 1% right now are paying close to half of all income taxes. And by the way, that proportion actually grew following the Tax Cuts and Jobs Act. 45% of the working age population is not working at all right now. And if you look at the bottom 10% of income earners, they're actually seeing a net tax credit of 5%. So fairness aside, the rich are already paying their fair share. But what I'm even more concerned about is that when we assault those who are actually creating wealth, it's not just that is immoral, it actually harms the people that we're actually claiming to try to help. Because it's not as if the wealthy are just keeping all of their resources locked up in a vault somewhere. That money is invested. It's invested in companies, invested in productivity, enhancing features. And that's a big part of the reason why our middle class has grown so much wealthier. 25% increase in real family income in the last few decades. And that's because of the big surge in productivity that is largely due to the fact that we do have a lower tax rate on the wealthy than elsewhere in the world.
And Joel, you're right. The Trump tax cuts, they increased investment, they increased wages, and they turned out to be even more progressive. But If you extend those the way we hear the Trump administration probably would like to, that's going to be incredibly expensive. How would you pay for it, especially given the deficit?
Well, you're right. We do need dramatic reforms in government spending. We're spending $88,000 per family of four right near on federal spending, and we're borrowing $25,000 per year. But this is not a revenue problem. Revenue as a percentage of our gross economic output has been relatively stable for decades now, whether you've had a 90% tax rate on the wealthy or whether you have a 30% tax rate on the top. What we need is real reforms. And sadly, neither leading presidential candidate has really put forward a plan to address the long-term cost drivers. The so-called Social Security Trust Fund will be completely out of money in 2034, which means politicians are going to be forced to either raise taxes largely on the middle class to pay for that or resort to the Federal Reserve printing presses to buy up government debt. Neither is a viable option. If we want to see our middle class continue to grow and to see total wealth produce increase, we have to address those long-term cost drivers. Raising taxes like the president's proposing is not going to resolve this problem. It's just going to hamper economic growth.
Natasha, it's tough, a wealth tax to do, and I don't know what kind of accountant you'd need to. There's so many problems. You know, you pay 1 year, then the assets go down the next year. It was unrealized. It's a nightmare. But would you at least concede that W-2 earners at 50, whatever with state and local taxes, if you're at 50, 55%, something like that of what you make, the real issue that you identified are those unrealized gains and all the money that rich people have that aren't. Would you be content to leave the people that are working through July 31st for the government and then they get a little bit left over after that? Can we leave them alone and just try to find a way to get at?
Asking for a friend, Joe? Is it?
I'm asking for. I live in New Jersey. I'm asking for a friend. Is there a way you can go after that huge amount of money that you're talking about without adding more burden to the W-2 types, the poor W-2 schleps?
There absolutely is, and I want to make like a couple of points to what Joel was saying. The first is that to your description of unrealized capital gains, like the effective tax rate on the Forbes 400 on billionaires in this country is 8%. That is lower than the tax rate paid by middle-income Americans.
That includes unrealized gains. That's
exactly.
not income as it's defined by the current IRS.
So
let's be clear about that.
Well, just to be clear, I totally agree with you that it is an income definition. But just to be clear, those unrealized capital gains are the source of wealth for the very wealthiest. And if you leave them out of your tax system, you're creating a source of inequity and you're creating the revenue problem.
If they're unrealized, that's not one and the same, Natasha. If they're unrealized, unless you're borrowing against them, and I can understand.
And if you're borrowing against them, as billionaires are doing.
But if you're not borrowing against them, they are not. I mean, this is a kind of crazy way of going about it. I can understand.
The real tax rate
for borrowing against them, you should be taxed.
And the real tax rate for the wealthiest is probably somewhere over 20-25%, as it's defined by the IRS.
I fully agree with the fact.
If we're talking about a tax on unrealized capital gains, what we're talking about is in actuality a property tax. And a property tax levied by the federal government is actually unconstitutional. But beyond that, beyond the constitutionality of it, that would be a tremendous hampering of growth. If we're talking about confiscating capital at that point, that just doesn't harm those that own the capital. That is going to be a direct impact on the middle class by depressing long-term productivity growth.
So I want to say a couple of things. I want to say a couple of things about the importance of revenue raising and also about this point about W-2 earners that we started with. I fully agree with the fact that thinking through how we raise revenue in the best way from the top is like an incredibly complicated question. I also agree with the fact, and I hope all of you agree with the fact, that today our tax system is a source of inequity, in part because of unrealized capital gains and our inability to think seriously about how to address them, in part, frankly, because we have a tax system that allows the very top to evade their tax obligations. The top 1% isn't paying $200 billion annually of what they owe today, as are large corporations not paying Microsoft owes $30 billion in back taxes that they're not paying that they owe today. So I think there's a lot of space for us to do much better than we have historically from these groups.